Everybody, my name is Mark Muller. I'm a director at Sanlam Private Wealth here in Mauritius. Very pleased to welcome you wherever you may be dialing in from all over the globe. We're very pleased to have you attending one of our webinars that we've been conducting regularly. Today, I'm very pleased to have Arthur Kump with us, and Arthur's going to run us through his currency comments. I'm going to introduce and give you Arthur's bio shortly, but just a couple of housekeeping issues. If you do have any questions, Arthur's going to run through a presentation for about 30 minutes or so, where he's going to look at various currencies. And then if you do have any questions, please just raise your hand on the icon. Alternatively, just post the Q&A and we'll get to you. So once again, thanks for joining us, Arthur. It's lovely to have you on board. For those that haven't attended one of our previous sessions with Arthur, and I think, Arthur, we're probably in our fourth or fifth one now with you. Arthur has been in the investment industry for more than 20 years. He holds an honors in economics, cum laude from the University of Stellenbosch, and an MSc Financial Economics degree from the University of London. So, Arthur, without any further ado, I'm going to hand over to you to run through the currency comment and then also the state of the world economy, as well as what you think markets are going to be doing. So, Arthur, once again, thank you very much.
Thank you very much, Mark. Hello, everyone. So, welcome. I'm going to share some slides on the screen, and hopefully you can see that. So, I've titled the presentation Global Shocks and Currencies, because this is where we're at. We're in an environment of global shocks, and they get reflected in asset prices more broadly. And obviously, those asset prices then include currencies as well. So the first point is just a few slides on inflation. So I know that you're tired of this topic. It's certainly been in the press and in all investment presentations for over a year as the main topic, I think. But the bottom line for me is when you are in an emerging market economy, anywhere in the world, the Fed matters, in my opinion. At the end of the day, we've seen this in so many cycles, Fed interest rate tightening cycles, global financial conditions tighten, and you see the impact on global EM currencies and their interest rates. So ahead of Jackson Hole, obviously quite important. Everybody's looking to see what the Fed says, and going into that, the expectation, I think, is hard to tell. But if I had to make an assessment, try and figure where the Fed is going to come out at on this occasion, I think that they're going to pretty much stick to what they've been saying before, and that is that they've got more work to do to get, obviously, inflation under control where they would like it to be. So, obviously, this chart, you've seen so many of them. UK, US inflation less than 30 to 40 years, and initially, the explanation for this was the pandemic. And that was right, because we had global supply chain shutting down, and obviously with that throttling of supply of products around the world, we had upward pressure on prices. Now, initially, there was
Arthur, sorry, can I just interrupt for a moment? Your sound seems to be coming and going. If you can just, I think maybe the microphone is not picking you up clearly when you come too close to the screen. Apologies.
Okay, so is this a little bit better if I stay at this distance?
Yeah, that's much better. Thank you.
Okay, all right, I'll do that. So initially, when the first wave of the pandemic had receded and we saw global supply chains opening up again, we did have quite a bit of easing of those supply chain pressures, but then in the second half of last year, Omicron hit. And that was particularly important because it hit Asia and the emerging markets of Asia especially hard, and policymakers reacted quite swiftly, and large parts of economies were shut down, and that had a very big impact on global supply. So this index put together here by the Federal Reserve Bank of New York is an index, 0 being relative to long-term mean, with the long-term mean, and then obviously plotting the index relative to that. So the higher the index, the worse the global supply shock. And they put this together using a range of indicators, including delivery times, order backlogs, input prices, output prices, freight rates, both air freight and shipping rates. And so it's quite clear that we had that very strong second wave and a very sharp second shock to global supply. That, fortunately, is easing up again, but it's still elevated. And that is still reverberating through the global economy. Of course, as the pandemic hopefully becomes endemic, this should recede, and along with it, a lot of inflation pressure. The point being, though, it wasn't just the global supply shock, although obviously clearly important. I think that there were far more fundamental factors building up, particularly in countries like the US, some developed markets, that were feeding through into inflation more broadly. The Fed also got a little bit unlucky on this one, and we'll get back to that in a second, because the initial assessment was temporary supply shocks as they fade, where inflation will come back down, and that didn't happen. Of course, the Fed at the time was also banking on the labour market normalising, and for the labour force participation rate in the US to go back to its pre-pandemic level. That didn't happen. But just an indication of that these price pressures have been broadening. This is the PCE deflated trend mean for the US. All that it does is it chucks out the outlying price increases. So it's something like a measure of underlying trend inflation. And one can see there more broadly, it's been picking up quite significantly in recent months. So it still stays about 4.34%. It's still quite elevated. Right, so what is this fundamental problem that I'm talking about? Because if I'm right that this is a fundamental problem, then clearly the Fed needs to keep going for quite a bit more. And we're not done with the Fed interest rate hiking cycle, and that's one of the pillars, in my opinion, that has been supporting the dollar. Of course, although we're seeing more tighter monetary policy beginning to emerge elsewhere as well in DM. Left-hand chart here shows you, it's just straightforward, the level of money supply, M2 in the US, and it's just plotting off the left-hand axis, just in dollar trillions, plotted against the cumulative federal budget deficit, the right-hand axis, also just dollar trillions. And one can see there at the height of the pandemic, the initial phase of the pandemic, there was a sharp increase in money supply, and it was quite closely correlated with an increase in the federal budget deficit. That's when you're writing checks and posting checks to people in the US. Now, we've had high money supply growth since the global financial crisis, a lot of liquidity in the global economy, and we've never really worried about this as an inflation problem. The reason for that is the demand for money is not stable, high liquidity preference, and so there wasn't too much money chasing too few goods. But I always get a bit concerned when I see a strong correlation between money supply growth and inflation, because the great inflation episodes in history around the world have had their roots in fiscal policy, and fiscal policy that's too loose. The US has to tighten fiscal policy and consolidate fiscal policy over the next couple of years to address this particular problem. The second one, and this is probably the one that's more pertinent, that we're seeing comments on every day. This is the one that the Fed alludes to, because the Fed, its models are pretty much predicated on the trade-off between wages and unemployment. Unemployment being a function of how strong the economy is relative to its potential. Very simplistic chart. What it shows you here is that total non-farm job openings in the US standing at over 10 million people, and unemployed people at less than 6 million. So you have that kind of a gap between the number of unemployed people and the number of job openings, and quite clearly there's upward pressure on wages. That has started receding year-on-year terms a little bit of late, but still quite elevated. And of course, the problem is labor productivity very weak. So unit labor cost growth is very strong. Now, at this point, it hasn't translated yet into retrenchments. And while this unemployment rate remains this low, in my opinion, the Fed keeps going until the unemployment rate picks up and starts meaningfully lowering wage growth, obviously then being a key underpin for what happens to the wage price process going forward. So here's where the Fed was unlucky. I mentioned earlier that hoped that the labour force participation rate would recover, and it did for 25 years, for people of 25 to 54 years of age. People my age, though, 55 and older, we didn't go back to work as keenly. And a lot of us stayed out of the workplace in the US. And one can see here that overall, therefore, that's kept the total labour force participation rate lower than pre-pandemic level. And that's important, because this category of 55 years and older, it's about a quarter of the labour force in the US. So it's not unimportant. It's clearly one of the key drivers here. So against that backdrop, I expect the Fed at Jackson Hole to make similar points to this. At the end of the day, also, they're not particularly sure how much monetary policy tightening is needed to actually then bring inflation down to where they'd like it to be. So to be clear, it does look like in many parts of the world, global inflation is peaking. So we're going to see the year-on-year rate in inflation coming down. Lower energy prices, of course, are really helping quite a lot. Core inflation rate might be a bit more sticky, but generally, I think also as those global supply chains continue to hopefully mend, we should see lower inflation through this year into next year. The point, though, is how much monetary policy tightening do you need to bring inflation down to where the Fed would like it to be, so 2% for the PCE core deflator. And here's where the difficulty is, because on the committee of the Federal Reserve, look at the long-term projections, they range sort of between 2% and 3% for the neutral interest rate in the US. We at Sanlam lean towards the 2%, but it's important to note that there are members of the FOMC that look towards 3%. So at the moment, with the Fed funds rate where it is, if you're looking at 2%, well, then it's already starting to move into tightening territory. But against this fundamental backdrop, I would think that it would need to go further. So we're looking at about a 3.5% interest rate peak for the US federal funds rate, which would be starting to move, in our opinion, significantly into tightening territory. Probably see the unemployment rate start to go up, and with that, inflation starting to come back down. Important point, though, is I think even though a lot of this is priced into markets, it's difficult to see how EM currencies make a lot of ground until it's quite clear that Fed peaking interest rate cycle is in fact peaking and starting to come down. So the market's very confident in the Fed's ability. This is the five-year forward inflation expectation rate. So if you were to move 5 years forward from today and then look 5 years ahead for the inflation expectation in those next 5 years, the market's saying they would expect inflation to be about close to 2.5%. I think it's about 2.45 there. Of course, the target is 2. But nonetheless, it is very much an expectation that the Fed can start bringing inflation back down to where you would like it to be in the long term. Right, so that's the one set of factors that's important for emerging markets, the Fed and its tightening cycle and tightening global financial conditions. The other one is China, and in part because of China and its demand. So we've seen in previous years, obviously, the importance of China for commodity demand, and that feeds through into a number of countries on our continent. So for a comfortable story, commodity prices have been quite elevated. Yes, a lot of these commodity prices have started coming down. Metals and minerals prices over the last short while, but relative to a year ago, they're still very elevated. And this is very supportive of a number of EM currencies on our continent in Africa. So it's important for us that China recovers second half of this year, and in Asia more broadly. That is an assumption that we are making. So if you look at industrial production numbers, the retail numbers are not showing here. That's shown a nice sharp bounce back in the latest month of data. But I think the issue for China here, though, more broadly, is that monetary policy loosening, which we've seen, general policy support, and hopefully an emergence from the shutdowns that we saw earlier in the year, in the second half of the year. Although that cyclically should lift growth, I think that what is beginning to show quite strongly in China is a long-term structural story. And that long-term structural story is that it's harder and harder to maintain productivity growth. And if you think that productivity growth or GDP growth is a function of productivity plus employment growth, there are two problems, because of population growth in China, and therefore employment growth long-term would be particularly strong. And then also from a productivity perspective, because the right-hand chart here shows you that the capital output labor ratio is very high, and so is the investment output ratio in China. And the problem with that is that when you see that, very typically it's a point in time when the marginal productivity of capital is beginning to decline. It's harder to maintain productivity. We've seen this in a number of other economies through history, and typically that's a period when you move into slower growth regime. And if you just look at it simplistically, just the trend in China's growth rate since before the global financial crisis, in fact, and the growth differential with economies in the rest of the world, it's quite clearly coming down. One would obviously hope that it still manages to settle in a trend growth path of, say, around 4%, because that would still be a significant underpin to global demand and commodity prices. But one has to bear in mind that there are risks here. One of the risks that a lot of people are discussing, of course, in China, just to finish off on this, is the property market. So this was a lever that China used to pull in the past to reignite its economy when it needed to, and that is not the option that it used to be anymore. The policies have changed there, quite clearly trying to make housing more affordable for more people, trying to dampen speculative activity. And clearly with those background risks in the property sector, it's not the policy tool that you could use like you used to previously. So we expect something of a rebound in China, second half of this year, cyclical bounce, but we are wary about this long-term structural backdrop. But of course, there are other, it's not relevant necessarily to our discussion today, but it's much more longer term. But one underpin potentially is, of course, the shift to a zero carbon environment, which we can shift in that direction over the next few decades. And the reason for that is I was surprised the other day, for example, to learn that an electric car battery has more than 70 kilograms worth of metals in it. And then, of course, also other areas of the global economy in emerging markets, hopefully countries like India growing a lot faster than other parts of Asia as well, for a long-term underpin for commodities. One thing I would say on commodities before we get to some more specific points on currencies is that if you look at the current level of mining exploration activity to global GDP, it's very low. And so there is a constraint on supply. Yes, of course, it's now meeting a global slowdown. And so then you've seen some of those commodity prices coming down recently. But from a structural backdrop, it still remains so that mining activity globally has been very depressed. It's something very similar to what we saw before China began its investment boom in the 2000s, and we saw those high commodity prices. Similar level of investment to GDP to what we saw back then. Of course, it takes a while for these mines to come on stream once you make the decision to do so. Yes. On specific currencies,
can I just ask you, just be aware that there are the sound is bouncing a little bit. So okay. If you can just bear that in mind when you present, maybe just up the volume a little bit if you don't mind.
Sure. I think I'm on 100%. So what I'll do, I think it's because I am shifting forward a little bit from time to time. So I'll try and just stay steady.
Thanks.
Okay, so on policy interest rates, on the dollar. So the dollar is the thing that we're talking about. Yeah. A lot of currency weakness that we have seen is reflecting a strong dollar. And there are various reasons why the dollar is strong. One of them is relative monetary policy tightening. Much faster on interest rates, shrinkage of the balance sheet, whereas, for example, a country like Japan is still very expansionary on monetary policy. And we've seen that in the weakness in the Japanese yen. I think this remains an underpin, although euro area is getting going now and the UK is getting going now. And of course, at some point, as this year wears on and inflation in the US comes down and markets start to look forward to the peak in US interest rates, then this factor becomes less prominent than what it is right now. But currently, it's been a significant underpin. And again, ahead of Jackson Hole, something to look for in the comments of the various speakers there. Often it's also argued that because the US is running such a large current account deficit, it should have a very weak currency. I think the way that I look at this, though, and I've heard this argument many, many times, and it doesn't seem to come to fruition very often. And the reason for it, I think, is that you may run a current account deficit, but if you look at the US, the yield that it's earning on its foreign assets is significantly higher than the yield it pays on its foreign liabilities, or it has been for many, many years. And if that stays so, then there's a future positive income stream there. One doesn't know how long that positive income stream remains into the future, but nonetheless, the present value of that must be particularly large. And that obviously is then a mitigating factor for the current account balance argument. But currently, I think one of the main, other than monetary policy, the main factor that we're seeing is Europe. And we have a war in Europe, firstly. And secondly, we have, as the war proceeded and as we've seen bond spreads in the euro area jump again, fragmentation risk has been back on the table. So I think until you address these two issues specifically, the risk, the US dollar remains the world's reserve currency. Yes, central banks hold a little bit less than they used to, but it remains the world's reserve currency. And in times of uncertainty, capital is going to drift towards that currency. So I think in this environment, it's difficult to tell. The bottom line for us is that the dollar is overvalued. How much each one will have its own assessments. In our view, it's about 20% against the euro. But it's not just hanging at these levels until some of these issues are resolved, until it's more clear that the Fed interest rate cycle is peaking, and until it's more clear that fragmentation risk is resolving in the euro area. unfortunately, on the war, I am concerned that I'm seeing escalation there, not de-escalation. It's a concern for me that might be protracted, albeit with periods of relative peace in between. Okay, so the dollar could hang in there for a bit, but it is already quite overvalued, and I would hope that it doesn't strengthen too much more, in the sense that would have obviously adverse repercussions for expectations for US for EM currencies. Similar argument holds for the British pound. British pound very weak. One of my concerns is it could stay that way against a pretty strong dollar while you have the stagflation risk in the UK. If that were to abate, then perhaps along with monetary policy tightening, we're reducing the bank rate 1.75%. That might help the pound at some point, but again, here it's pretty much a dollar story. Okay, some comments then on African currencies. So global financial conditions tighten, and in that environment, suddenly some things become important. How much money have you borrowed? And on the African continent and our continent, there are quite a few countries that have a high level of borrowings and a high level of external borrowing requirements, high level of external debt relative to foreign exchange reserves. And so we've seen significant pressure on currencies and yields in these countries. Just looking at African Eurobonds and the spreads, what this table shows you is for numerous countries, the yield and the spread over the US Treasury. The data here is up to the 5th of August 2022. Just to get the general picture, if you look at the far right-hand column, it shows you the total return on these bonds over 12 months. You can see they're significantly negative. Also, the spread over US Treasuries, the change over 12 months, second right-hand column, look at the big jump in those spreads that we saw there. And obviously that's then to attract capital against the backdrop of weakening currencies. Now, what is interesting is that over the last sort of month, or the month to the 5th of August, some of those spreads start to come down. So the expectation that we're starting to see, at least begin to get an idea of where the Fed is going to be hiking to, and once that's priced into markets, hopefully some stability returning, and this might be the first indication of that. As I said, as we move through the second half of this year, perhaps that becomes more a dominant theme on our continent. Right. So on the rand, now the thing about the rand is I like to, when I look at currencies, look at purchasing power parity. I know people's eyes glaze over. At the end of the day, small open economies, and a lot of economies on our continent are small open economies. It makes sense to argue that in the long run, your currency is going to move in line with inflation differentials, but you get big, obviously, deviations from that level that's implied by inflation differentials, and that's because of currencies in the case of commodity producers, and obviously capital flows in the near term. So as far as the rand is concerned, if you look at the currency in over the last couple of decades, when it gets to within 3 standard deviations from that fair value line that we calculate, and incidentally, we don't use an initial equilibrium year, we actually do a best fit over time. So that eliminates the risk of having to pinpoint that year exactly. When we get to 2 or 3 standard deviations, when the rand is really weak, it's tended to come back quite significantly over time. And we're at that point again, we're about 3 standard deviations away. The reason it comes back is, again, markets have confidence in the South African Reserve Bank, and usually the trigger for it is the South African Reserve Bank beginning to hike interest rates in response to a weak currency, because that weak currency is pushing up inflation expectations. And we're quite confident that the rand, that the SAR will do its job, and you can see it in our inflation forecast for next year, inflation coming down. And we think that dynamic is then again a factor that then stabilizes the rand over the next year or two and helps it to improve. Currency forecasts always carry risks, and we understand that but you have to try and assess relative to history and relative to information that you have in front of you what is likely to happen, and that is our view, that with the SAR hiking interest rates, and we think it'll do a complete job of it, probably around to 6.5% in the repo by the end of the year. Base effects will also help bring inflation back down through next year. Already our petrol prices come back down quite a bit, and that should hopefully then feed through into more currency stability. And that obviously is important for currencies on our continent in the CMA, for example, the Namibian dollar. Another thing is you get obviously a wide divergence of currency movements on the continent. So we can look here just the Kenyan shilling and the Mauritian rupee plotted against the Zambian kwacha. And you can see the extreme underperformance that we saw in the Zambian kwacha in recent years. Why is that? Again, one of the key factors underlying this is inflation.
And when you look at inflation dynamics, in Zambia, for example, a key component or key driving force of that was weak fiscal policy. That's now changing, we think, but historically that's been the case over the last number of years, and that's in large part been behind this underperformance. So we can see here, just two charts on Zambia. We went from an era of high money supply growth reflecting bank lending to the government, large fiscal deficits. So in other words, the fiscal deficit is a source of the inflation problem, always a concern, as I noted earlier. At the same time, potential growth rate was receding and deteriorating and still very much reliant on commodity prices. And obviously, along with high inflation, that then obviously weighed on the currency. More recently, what we've seen is interest rate hikes, inflation beginning to recede, and then also combined with, yes, they are lower, but still relative to a year ago, high commodity prices, or copper prices, particularly important for Zambia, big current account surplus, and we saw the currency starting to come back now quite meaningfully. In this case, drawing a PPP line is not necessarily very helpful. You can see the very large deviations we've seen there, but it's more to make the point of how extreme this weakness was, and that this weakness in large part was of concern that you would continue along this path of poor fiscal performance, and then that would end up with hyperinflation. We haven't gone that route. It does seem like we're now going a different route, especially now with hopefully by the end of this month an IMF deal in place with the extended credit facility. We're starting to see liquidity, or folks' liquidity improving in Zambia. Foreign exchange reserves are improving or have improved as well. We're looking forward to that extended credit facility, as I said, large current account surplus, and then also a number of reforms to lift economic growth. And then also fiscal consolidation is what you would expect on an IMF program, although the fiscal deficit is quite large and an expected minus 6.7 this year. But with inflation coming down, monetary policy in inverted commas normalizing, interest rate hikes that we've seen, combined with what should be additional external financing if we get the IMF program up and running, we think that this currency could remain quite stable over the foreseeable future. And there is one warning, though, that it is quite crowded in terms of non-resident debt holdings. So there's always a risk that you do a misstep on the fiscal policy front and that capital flows out again. But for now, that's our best assessment. Kenyan shilling is an interesting one because it does track its PPP level quite nicely over time. A while back, we had argued, I think it's about a year, more than a year ago, that the Kenyan shilling would, I think it was 2 years ago, should depreciate in line with its PPP differentials to around fair value of 120. It's got to that level. With higher inflation in Kenya likely relative to the US next year, we think that maybe there's a bit more weakness to come, but not necessarily a lot. This is quite a good anchor. The risk, of course, for Kenya is its large external borrowing of increasingly having to fund locally. And if you look at the current account deficit, it's very large. Budget balance deficit, very large. It's got large twin deficits, not a good combination when you've got the Fed tightening monetary policy. So, we probably expect a little bit more weakness, we think, but again, pretty much largely in line over the next year or two with its inflation differentials, unless there's a fiscal problem. There is a very high level of revenue payment, interest payments to revenue. Is a large external borrowing requirement, as I've indicated, and we don't want fiscal policy to go awry because that would then be reflected in higher inflation and a weaker currency. And then finally, on the Mauritian rupee. So here, quite clearly, again, we're not anywhere near my favorite PPP line. It almost seems like I shouldn't even be bothering to use the PPP line. It's disconcerting because the PPP line was showing that this currency should be quite stable, and yet it's weakening quite materially, as we have seen. There's persistent foreign exchange demand here. There's been some recovery, I think, of capital inflows, but still seeing we've seen until recently the Bank of Mauritius intervening. I think the issue here is twofold. One is the current account balance, that very large deficit, minus 13.6% of GDP. Obviously, partly a reflection of the legacy of tourism having been weak because of the pandemic. And the other one, in my opinion, again, is monetary policy. 2.25% policy interest rate with above 8% inflation and about 7% for core inflation. Materially negative real interest rates. I think interest rates need to go up significantly more So my concern is that although I would be tempted to say the Mauritian rupee should be stable to firming on the back of small open economy, inflation coming under control hopefully through next year, but the important caveat there is we're going to have to see significant monetary policy tightening. Also, a significant improvement in the current account balance. So I'm not going to get too excited about the currency until I see that. At least there's some good indications. I saw data coming up this week on tourism. Just want to quote the numbers here. First half of this year, Mauritius saw $575 million worth of tourism inflows compared to $25 million first half of 2021. Obviously, that was because of the pandemic. But just to put the numbers in perspective, in 2019, for the year as a whole, before the pandemic, tourism received $1.8 billion with 1.4 million people coming into Mauritius. And in 2020, we saw only 308,980 tourists coming in. So hopefully that, along with what is expected to be a lot sharper growth in GDP this year, 7 to 8%, hopefully if we get some improvement in the current account balance, if those tourism receipts improve, and we see improvements in foreign exchange reserves, along with monetary policy tightening, that would be a signal for the currencies to start steadying and start hopefully maybe even improving a bit. But it's important caveats. That's what needs to happen. Okay, so yeah, one of the things, of course, is bring that inflation rate under control. You can see it's right up there with where the US is at this particular point in time. So pretty elevated inflation. So that's just a few general comments about global shocks, inflation, why it's important, the reaction of the Fed being so important, how that's feeding through into currencies on our continent, and then just a couple of slides there on what that implies for individual currencies. Thank you very much for listening, and looking forward to some questions.
Yeah, thanks, Arthur. That was very informative. Please just ask any questions that you may have. Straight to Arthur, although most informative. Arthur, in terms of, I think a lot of the attendees on the call will be looking at their investments and investment solutions. Where would you be putting your money? If you had X amount, what currency would you be hanging your hat on?
Mark, pretty much depends on the duration of your view. I'm reticent. At the moment, the dollar has been strong because of the factors that I've indicated. I don't see too much change there yet. What makes it difficult is that the dollar has had a very good run now, and that it is in fact overvalued. So if you take a long-term view, then I'd be a bit more wary of the dollar. But for now, in the current environment, especially against the euro, for example, with winter coming, we first need to see what the impact is of energy prices. We also still need to, it looks like the sort of data coming out, the PMI data is beginning to point to recessionary type conditions in the euro area. I'm still quite concerned about the background of that war. It seems to be escalating, not de-escalating. And there just doesn't seem to be too much of an alternative to the dollar. And China, of course, at the moment as well, a bit of uncertainty around growth. I think also, currency convertibility, also the size of the economy is obviously a very large economy, but still size of capital markets, etc. The dollar is still pretty much hanging in there in the reserve, as a reserve currency. And I think wild times, the best way I can put it is wild times are uncertain. The dollar could still hang in there. I don't think it makes too many more gains from here because it is so, in my opinion, expensive. If you buy that view, then on a longer term view, you've got to be a bit more wary dollar. But for now, I do think as this year wears on and we start seeing the potential peak in US interest rates, there could be some currencies around the world, and including in EM, and as I've indicated on our continent, that could start looking a little bit cheap. But we first need to start seeing that the Fed is in fact gaining a lot of traction on inflation, that we can be comfortable that what the market's priced in as interest rate hikes is in fact realistic. So currencies, I'm at this stage, I'm not running away from the dollar, but there doesn't seem to be too much easy money to be made in currencies at the moment. There's not something that's, it's clear that the dollar's overvalued, but it's not clear to me that we should be running from it yet.
Then I guess perhaps a slightly unfair question is tomorrow is quite an important day. You've got Mr. Powell giving his presentation. Markets seem to have priced in a hawkish approach for him. If he does a dovish approach, do you think there's going to be a bounce? I've read an opinion piece that seems to be the thought.
Yes, I think that's pretty much it. I think investors, if I'm reading it correctly, are expecting on balance that he would come out quite tough. That's my expectation as well. The Fed's most recent minutes, the problem that they have is that there's the minutes that you read, and then you read your own between the lines. And my between the lines reading is, we're not quite sure how much we've got to hike here before this thing slows enough, or how much the economy's got to weaken before inflation slows enough. So until we're sure about that, we're going to keep hiking. And I think that's going to be the message. And also, I think this emphasis on this is not just pandemic-related supply chains mean we're okay. This has become more fundamental. Wage price spirals, we haven't seen them for decades. But this could potentially turn into a significant one in the US. And until they start seeing the unemployment rate go up meaningfully and bring down that wage growth, I think they just keep going. So I think it's a reasonable expectation that investors, that my understanding is that they're going in with that expectation. I think that's probably the right one.
Interesting question that's come through. Sorry, Arthur, go ahead.
Of course, if I'm wrong, then there'll probably be a bit of a bounce. I just think that the overall realities we have in the world economy are weighing pretty much here. Just remember as well, in this, I think, the previous time we had a real inflation problem in the US, it was also letting up too quickly on monetary policy tightening, and that caused reacceleration in inflation. The Fed will also be aware of that.
Tomorrow will tell. It will be very interesting. Interesting question that's come through, Arthur, perhaps putting you on the spot. But what are your thoughts on the announcement of BRICS countries in midst to create a new reserve currency? Turkey, Egypt, and Saudi Arabia considering joining.
Well, I think if you're going to be a reserve currency, you need to obviously be an attractive currency. And I think that's going to require a lot more alignment of monetary policy and fiscal policy than that at the moment. We know that Turkey's got hyperinflation. We know that it takes a different monetary policy stance. I'm not going to judge either way on that, but at the moment, also in Egypt, we know that the external borrowing requirement is very, very large, and a lot of that is in dollars. But having said that, I think that, over time, one is likely to see a shift towards a reserve currency of potentially that nature. Reason being that we're already seeing foreign exchange reserves held by central banks, that this is held in dollars and more is held in other currencies. And over time, a natural progression would be towards, for example, China. In that instance, but what you do need, of course, is you need greater currency convertibility as a prerequisite. That would be a very, very important one. And you probably need to see increased size of China's, it's a large trading partner, but you probably need to see increased overall size there as well. So potentially, yes, but I don't think it's as easy as just putting a whole lot of countries together. Each of those countries must have a lot of institutional strength, currency convertibility, and very sound macro and monetary policy.
Thanks, Arthur. Arthur, I'm going to put you on the spot. When we did our last currency commentary, you gave a prediction on the ZAR versus the USD over a course of 6 to 12 months. Can I hold your feet to the fire and ask you for your view on that again?
We very much we prefer to look at the currency at a time like this when it is 3 standard deviations away and it's very weak, and the ZAR is doing its job. That's when we like to, we tend to be more reasonable. You can never be sure over the currency, but that's when we are relatively more confident that the Reserve Bank anchors long-term inflation expectations, and that's what anchors the currency over time. So we think we're at that point. One thing, that is in the background that will become increasingly important as we head into next year is the Financial Action Task Force. So if we do get grey listed, so where we are at the moment with the currency, just to put in perspective, our opinion of the fair value is around 14. So we would expect it to all else equal drift in that direction over the next year or two, as it's done on previous occasions in an environment where the SARB is doing its job, which we think it is. There's always a caveat. You don't want to collapse in commodity prices. That's the first thing. You don't need a global recession. So that's the first one. The second one is, but at least we've talked about the structural underpin to commodity prices because of the low level of mining investment. So there's at least that. Financial Action Task Force grey listing need not necessarily be have severe consequences for the currency. But if we were to be grey listed and we weren't showing sufficient adjustment towards getting off the Financial Action Task Force grey list, that would be my concern, because we're a small open economy and highly integrated with the global financial system. And if we were to start, we could potentially then start seeing significant capital outflows. And that's my caveat, is that if hopefully we don't end up being grey listed, but if we do, and I think there is a significant risk that we do, it's going to be very important that we show that we're moving in the right direction very quickly to get off that list again. Otherwise, we could start bleeding capital, and that rand might just remain weak. But base case, this is the time we like looking at it. Very weak, SARB doing the right thing. The next big move, in our opinion, should be stronger.
Last question, just cognizant of time in the last 2 minutes, is a question from Mike. Do you have a view on crypto from here?
I don't have a view on crypto forecast, but I have a view on crypto. And my view on crypto is that initially, the bottom line problem for crypto is it doesn't earn income. So it's not a natural asset that we as an asset manager want to own. It doesn't earn your dividend, doesn't earn your interest. We do think that the underlying technology is particularly useful. And then also, just in terms of some of these, it's increasingly going to be regulated, and I think that there is the Reserve Bank, for example, has been looking at the potential for issuing a cryptocurrency. I think there's certainly space for that. I think there's lots of positives in crypto in terms of costs, etc. But it's going to, in my opinion, be regulated in South Africa. I don't have any idea where the price is going to go. But I do like some of the thinking on some of these crypto exchanges, and some of these contracts are being written. And one of the bits of thinking that I picked up on, and it's just for our industry more broadly, is that some of these contracts are written. So when we lend someone money, we do a credit assessment, and we decide, how much will that person's ability to pay us back good, or is it poor? According to that, we will then judge what interest rate we should be applying. In some of these contracts, this idea of actually incentivizing good behavior and incentivizing people to pay back, which is a completely different way of looking at finance, because in theory you could then you're actually switching it all on its head. So I think within the crypto world, I'm not an expert, I must put that up straight away, but from what I've been reading and looking at, it's a very interesting world, and I think there's some interesting underlying dynamics there. I would say that what is clear to me, I'm not going to take a view on exactly where it would go, but what is clear is that during risk-off times, crypto hasn't done well. There's a good correlation there between risk asset prices and crypto. It's managed, so if we have a risk-off environment becoming lasting with easier global financial conditions, I think that would be the point where crypto would again come into its own. But that's just some loose thoughts around crypto. I'm certainly no expert on it, partly for the reason that we don't invest in it because it doesn't earn income.
Last question. Thanks for that, Arthur. Last question. What are the risks, particularly to markets, of the Fed moving too quickly in its tightening cycle and completing it in just a few months? So just a question, I guess, that opens up quite a long debate. But if you can answer that as briefly as possible, please, Arthur.
I think it's a significant risk that the Fed gets going and finishes up by the end of this year, or very early next year. I think there's that risk in South Africa as well. I think central banks, its actions have shown that this year. What is less clear to me is where's the neutral rate for the US. You know, if it's 2%, then 3.5% is already material tightening. But if it's as high as 3%, then we've got quite a way to go, potentially beyond 3.5%, and that does worry me. My view is that the neutral rate is 2. That will be at 3.5, but close to 3.5 by the end of this year, and that would be the peak. So yes, so I think the risk is that it's not necessarily so much the peak, but the timing and front loading. Central banks have seemingly moved in that direction. South Africa as well.
Yeah, thanks, Arthur. Arthur, that's been, we're fresh out of time. I guess we could carry on with this, but once again, Arthur, thank you very much for joining us. Most informative. If your questions, we didn't get to them, please feel free to email me, get in touch with us. Happy to flick those on to Arthur. Arthur, have a great day, and thanks once again for joining us. Much appreciated. Thanks, everyone. Cheers.